Well, Ben, we just finished the first Think It Heart podcast of 2022. I'm super excited.
Yeah.
Okay.
Yeah.
If you go back and listen to the whole thing, I told Jeff, CEO of Stack Capital Group, that I want his job. He has the most interesting job. How do you think it went?
Yeah, I think it went great. I mean, I just say just before we get going though, anything we discussed today is not investment advice. We did mention a couple names of stocks throughout our conversation. So, if you any of those stocks we mentioned, certainly talk to your advisor or talk to us. So no recommendations, just the boring stuff is those are recommendations. But after that, the discussion with Jeff was awesome. He's looking at private companies all day, every day. And he said, last week, as a simple example, they looked at 35 different businesses. And I can see why you want the job. It's super interesting.
That is super interesting. Way more interesting than this, I'll tell you that.
So part of why I wanted to have Jeff on is, the company that he's CEO of is called Stack Capital Group. And it's one of the first ways that I've seen anyways to invest in private equity for the average investor. So most other ways you could access before was hedge funds. Lots of them have $5 million minimums. So, their goal is to kind of democratize private equity investing for Canadians. So super interesting offer.
Yep. So what are some of the highlights then from the interview? What did you really take away from it?
Yeah, he talks about how how much growth is happening in the private kind of startup space. And I think one of the more fascinating things for me is that the rate of change in the actual corporate world right now is going super fast. And a lot of these companies are making money. And the one thing he mentioned is there's a lot of private companies that are profitable now, which is very different than the past. So you got these businesses that are starting up, and he'd mentioned one crypto business, I think, or exchange that went from starting less than 3 years ago to making billions of dollars in revenue right now and profitable. So it's just amazing at how fast things are changing, and it's exciting that there's all these new businesses starting to come up that we need to pay attention to and present really unique opportunities for us and for our clients.
Exactly. Well, on that note, without further ado, here is the interview with Jeff Parks from Stack Capital Group. All right. Welcome back to Think It Heart. I'm Scott Goodfellow. This is Ben Hart. Ben, we got a big one today. Eh?
We do. I'm excited.
Big guest, CEO of Stack Capital Group, Jeff Parks. Why don't I kick it over to you, Ben? Give us a bit of an intro and get right into it.
Yeah, for sure. So I'm excited to have Jeff with us. It's the first one of 2022 for us. We made it through a year of podcasts and YouTube, and I think we got somewhere close to 40. So we're happy with the effort we did last year, and looking forward to this one. So, you ready to go, Scott?
Consistency is the key. Just week after week, just putting in the reps, just grinding away. I'm sure Jeff will tell us the same thing.
Exactly. Right? Gary Vee didn't get famous overnight.
That's it. Translates to all industries, doesn't it? All right.
Exactly.
Why don't you bring our guest in here there, Ben?
Love to, for sure. So we have Jeff Parks here, CEO of Stack Capital Group. I'm very excited to interview Jeff today. We participated in the IPO last year when Stack came to market. I thought it was a super unique offering. It's very difficult to get access to private equity, venture capital, the kind of deals that Stack does. So excited to hear a little bit about what you do, what Stack does, and certainly the story. But first, Jeff, maybe you could start off with telling the viewers a little bit about yourself, who you are, why this business, how you got interested in investing. That's kind of one of my favorites always. Like, what was it that brought you here? So, Jeff, please go ahead.
Yeah, thank you very much for having me, guys. Really appreciate it, and glad I'm the first one to kick off 2022 for you. So just a bit about my background, and reason why I ended up going down the finance route was I was in university, and my brother, he worked in the hedge fund space, and I always had an interest of kicking the tires in different companies. I was like, oh, he's doing something interesting. So it was either the doctor route or the finance route. I ended up going the finance route after following in his footsteps. And I have to say, like, one of the programs I always watched as a kid was kind of how it's made. So I always like going through like the factories, looking how things are done, where the bottlenecks are. So I always like that analysis of companies, and that's what brought me into the hedge fund business. So was at a hedge fund for 10 plus years, and that's when I transitioned out of them and opened up Stack Capital with my three partners, Jason, Brian, and Jimmy. What we wanted was a permanent capital structure where we could democratize access so that anybody can participate in these late stage and growth stage companies. So I always had a knack for picking different businesses. We got a structure together, got my four partners together, built a board of directors. Same thing with our advisory board. We have some very, very interesting people on there, from people who sat on the board of the TSX to one individual. He sold his business public company to Goldman Sachs for $1 billion. Another individual, he was chairman of Canopy Growth. Another individual, 30 plus years in Silicon Valley. So we've built a unique structure, unique group of individuals that we're excited about 2022 and beyond.
Right on. So maybe a little clarification on the terminology for some people. You know, you ran the hedge fund before, and then you wanted to raise permanent capital. So maybe kind of just separate what the differences between the two.
Yeah, so in the hedge fund business, everybody has to be an accredited investor to participate. With what we want to do, we want to democratize. So not only are you an accredited investor, you can be a non-accredited investor. Anybody can participate in the investments that we're going after, and that was one of the big differences between the hedge fund and the permanent capital structure. Another piece is we don't have to worry about underlying liquidity of our portfolio companies. Hedge funds, for example, if they put money into a private business and that private business stays private for 5 years, but their clients want their money back, well, that's an issue in terms of liquidity. With us, individuals are able to trade the stock on the actual exchange without affecting that underlying liquidity of the portfolio. So those are two big differences between the permanent capital structure and the hedge fund business.
Cool. So, I mean, super interesting. It sounds, I mean, they probably don't want to call it a SPAC because I think that's a bad word these days. But certainly want to talk about some of them that happened in the U.S., but similar, right? It's a shell you raised with a view that you're going to invest in some of these businesses. So maybe you can tell me a little bit about the area that kind of the area of the life cycle of businesses that you find interesting and that's attractive for you.
Yeah, and you hit the nail on the head. As opposed to us just going and raising that cash, we raised around 107 million, and going out and investing in one individual business. We're looking for between 10 and 20. So you have a diversified portfolio, and we're going after the growth in late stage businesses. We don't want to go after those early seed businesses or early stage businesses because there's too much risk associated with them. We don't know if there's proven product market fit, whether the product actually sells. We want to know that underlying product sells or the service sells, and what our capital is really doing is coming in and helping it grow and propel that revenue faster so that it can one day come to the public markets. So we really want to steer away from those businesses that proof of concept hasn't happened yet. They have revenues. These businesses are established. So you can see that with some of the ones that we've invested in so far.
Yeah, definitely. I'd be interested to talk about some of the holdings you have so far and also what you're looking at. But maybe just before we get there, so the process is you raise the money, and then, you know, when you IPO'd last year, the market was pretty busy, pretty hot at that point. Have you seen it change much? And like, what kind of deals, like how many deals would you be looking at?
I would say let's just go to this week so far, and we're sitting what's today? Is today Monday? Tuesday. Yeah. I'll say last week, for example, we did a conference, and there were over 35 different companies that we saw last week alone. And then we're doing
Wow.
another U.S. conference this week where the list is just Zoom meeting after Zoom meeting after Zoom meeting after Zoom meeting, which is actually quite good because you can look at a lot of different companies very quickly versus flying to a different city and going to see them. So the deal, there's a lot of deals out there right now. A lot of companies are looking to raise capital, and you're even seeing on like the venture or private equity side, some of the funds in the States are raising blockbuster funds right now. They're solely going into the private market for these businesses. So there's a lot of capital. You've seen some of the companies in like the public markets, as you probably have seen with the NASDAQ 100. I think it was 50% of the NASDAQ 100 is off more than 50% from the 52-week high. So that hasn't stopped a lot of the flood of capital still going into the private markets, because some of these businesses, they're just incredible growth metrics that you see.
Yeah. That's cool. That's got to be an exciting place to be, for sure.
It's definitely exciting. It's definitely a lot of legwork and a lot of different companies, and I would say there's so many more than what are in the public markets. Like I think 10% if you look at overall capitalization in the world is public versus 90% of the businesses are private. So there's just so much opportunity out there that you can take a look at.
Yeah, so maybe first, before we get to, I got obviously lots of questions pile up as you talk, but maybe tell us a little bit about your process and what it looks like, and what would it look like compared to like an Onyx or a Berkshire or one of these other privates. Like what would it look like?
Yeah, so we see it's a little bit different than like the public market, where you can run a screen on financials on their K's and Q's or quarterly financials, and you can basically say, okay, I can judge it based on those numbers. This is more so you're knocking on doors, you're using your network that you've established between our advisory board, our board of directors, and us as a management team to go out there and hunt for certain sectors that we want to participate in. And then you're knocking on those doors to try and get into the data rooms, analyze those businesses, and say, oh, we're going to pass on this deal or we're going to play this deal. And then from there, companies go in the portfolio, and we're kind of looking at like investment companies who kind of want like a 6 to 36 month time frame to a liquidity event, whether that's an M&A, whether that's the company IPOs. And then we'll watch those portfolio companies over a period of time, and then if they're hitting their metrics, they're hitting what they said they were doing, we're happy with them. We also have the ability to trade out of them if they're not hitting those metrics. So once they're in there, we'll look to hopefully IPO those companies one day and then cycle out of them and right back into the private market.
Okay. Is there a lot of competition in that space in Canada for you?
There's not a lot of, I wouldn't say there's definitely competition in Canada. For us, we're more so focused in on the US in terms of those businesses down there. I think 85% of our portfolio has to be within North America. That's one of the mandates that we have. And when you look at the market, like it's predominantly US where you're seeing a lot of these disruptive businesses. Although I will say there's a lot of ones that are coming up in Canada. There's a really good ecosystem on the West Coast in Vancouver, obviously Waterloo and Ottawa. But yeah, predominantly U.S. businesses. And no one really focuses in on the permanent capital structure that we have. All these individuals, they raise capital in these funds, and generally what happens is the fund will have a 5 or 7 or 8 year time frame. And that fund comes to end of life, and maybe the company hasn't IPO'd. Well, those private equity or venture capital funds, they're now forced sellers of those positions because they need to liquidate for the underlying LPs. So that's another source of underlying liquidity that we can take advantage of because we don't have that finite life. We just continue on in perpetuity.
Yeah, that could give you a great opportunity, right? Somebody has to sell it at a low valuation.
I'll give you an example of one company that we saw 2 months ago. They were selling at a 50% discount to the last round because a shiny seller needed off the company. And now that company is slated to IPO. They're looking at raising at around $1.5 billion, and we could have bought shares around $500 million. So there's different opportunities that you see like that all the time. It's crazy when you can get those forced sellers to come in there into a market.
Yeah. So your network would be, I guess, one of the big differentiators. So you can get access. You can know these deals are happening. Is it the bankers that would be like the investment bankers, or where would you get these kind of opportunities?
A lot of them come from our own internal connections, but I will say a lot of the banks bring us a lot of deals as well. We were lucky to have RBC, Royal and Scotia as our top lead left. National Bank was participating in there as well on our deal, so they all bring us that deal flow as well, which is very beneficial. But the team that we've built from the advisory, like I'm going to give a shout out to Bill Ty, Brian Beatty. Bill Ty, 30 plus years in Silicon Valley. He's he's done very, very well in the private markets, from investing in Zoom early, Canva, Wish.com, Twitter, TweetDeck. Same thing with Brian Beatty, CFO of the largest division of Constellation Software. He's done extremely well, and he's done over 120 M&A acquisitions, which is very, very impressive. So you look at that power that we have behind us, and even like I'll say my CFO, for example, he's been in the crypto world for a significant period of time. So the incoming calls that he gets from different companies playing in that space, it's very, very impressive.
Okay, that's interesting. I've certainly got into crypto, I'd say fairly early for clients. A couple of years ago, bought Bitcoin when 3IQ did their first closed-end fund. So that's been interesting, and I think crypto's got a super unique kind of Web3, probably presents a lot of opportunities, but I'm sure there's a ton of potholes as well. So is there one industry that's bringing the most amount of interest for you right now, or is it pretty open?
I would say it's wide open. Like anything from the big thing with us, we didn't want to box ourselves in terms of like what we could look at. I think one of the only things that we can't really look at is biotech, right? The binary outcome of something working or something not working. We don't want to put our capital to risk on those underlying opportunities. But there's so many different trends out there, from tools for content creators, from the travel and leisure space. I'm sure all of us on this call, we want to go on a vacation, go to a beach or go somewhere warm, right? You're dying to get out of here. So there's a big pent-up demand in terms of those companies, to space, to e-commerce companies, to fintechs. I couldn't pinpoint one and sit there and say, no, we only want to look at these, just because there's so many different really, really good opportunities. And we want to give our underlying shareholders a balanced look at the market, so have somewhat of a balanced portfolio.
Yeah, for sure. I mean, do you think that that's been sped up by this lockdown, by COVID? Like all this kind of these unique business ideas has sped up because of COVID?
I think I definitely think some of them, like Zoom, is the perfect candidate of getting sped up in its adoption cycle. All of a sudden, everyone's at home, and what platform you're going to use? You're going to use Zoom. Now, I think some of these ones that have been sped up got a boost of growth very, very quickly, and then can that growth sustain over time? I think that's what you're going to see out there in the market, where you're seeing some of the multiples trade off of companies. And then there's the other ones that the growth might have sped up, but those other companies, the growth just dropped off a cliff. If you look at any travel and leisure company, but what's going to happen over the next 2 or 3 or 4 years with those underlying companies? I'm sure it's going to be quite impressive.
Yeah, they'll come back. I mean, the airlines got an initial big, huge rally, and they've all sold off hard. Even the gaming companies and the Winds and Las Vegas Sands, and these names have been hit pretty hard. I think you're right there. So it looks like so far you've invested in three companies. Yep. Okay. So maybe you can tell me a little bit about, obviously some people are going to know at least one of the names.
I think so.
And so maybe tell me a little bit about the three deals, why they're interesting, what attracted you to them, and because I think they're super interesting, and how they fit.
Yeah, so I'll start you off in order how we brought it out to the market. The first one was Varro Bank, in which case we put $5 million US into Varro Bank. It's the first and only fintech in the U.S. to have a U.S. banking license. So what a lot of these basically call them neobanks or challenger banks in the States, what they do in a neobank and a challenger bank is essentially a bank with no branches, a digital bank. And why Varro is so unique is having that banking charter, all of their competition has to borrow somebody else's charter, which means you're giving up half your margin. Which means there's some bank in the U.S. is basically taking half of a Chime's profit, or half of other competitors' profits out there, versus
Sure.
Varro Bank gets to capture 100% of that profit within the company. It's a big, big differentiator. It took them hundreds of millions to get that banking license. It took them 3 to 5 years to even get it approved. So very, very difficult to get. And they're going after 180 million battlers and builders, people who aren't serviced by the banks because the banks it's not profitable to them. They have bank branches that they need to cover. So it's a very unique one in the U.S. that we're excited to get behind. They raised around, at a $2.5 billion valuation, around $500 million. Russell Westbrook, he was an investor in them as well. So very, very differentiated fintech in the U.S. Second one would be Bolt Financial. In Bolt Financial, we put $6 million into that. 3 years ago, there's a patent that came off Amazon's OneClick Checkout. Everybody goes on Amazon, and when you're shopping, you just hit checkout, boom, everything's coming to your door, right? It's easy. So that it's very nice. So what they want to do is they want to democratize access to that one-click checkout. So they're building the one-click checkout for every other e-commerce company out there. So they had a partnership with ABG, which they own Forever 21, they own Volcom, they own they own just about like every brand. They keep on consolidating all these brands out there, like Brooks Brothers as well. Yeah. So they're building their user base, and they're building the number of one-click checkout options, and they're taking that payment flow into them. So it's kind of like a flywheel. The more merchants that sign up, the more customers that sign up. More customers, more merchants want on there. So we think they have such a head start to their competition, and that could be the de facto payment checkout for all of these other e-commerce websites out there. So that's a very, very interesting one. They raised, I believe, in the public realm, around a $6 billion valuation was their last valuation that they came out with, and we ended up putting $6 million into that company. It's rated one of the top tech companies in San Francisco right now. There was an article on it the other day. Okay. And then lastly would be our position indirectly into SpaceX. So obviously, I think the majority of people out there would know that company. Elon's been in the press for quite some time. And what attracted us, not only because that's like one of the private names that you want exposure to. I think everybody should have exposure to that in their underlying portfolio, and it's very, very difficult to get at that. I think the big thing that attracted us to it was the whole Starlink satellite network. I'm happy with them thinking that there's going to be travel to Mars and interplanetary species and that, but the real attraction is what he's built off. We'll go through the Falcon 9 launch first. To be able to reuse a rocket, before when we could launch stuff up into space, that rocket's going to come down and it's going to burn up. So your launch cost is extremely expensive. But what he figured out was, if I could launch that rocket up, it comes right back down, lands on a pad, and I can reuse that rocket, I can take my cost down significantly. So what he's charging people is staying the same, but he continues to use these rockets, so his costs keep going down and his margin keep on going up, which is very, very impressive, how he's built that. Other piece is the whole Starlink satellite network. You look at people in like rural America, or somebody in the Yukon, or even some people up in like Parry Sound, Muskoka area. You can't get good access to internet. So people will pay out the wazoo for that internet access. You even look at like countries in India. Will governments start subsidizing different cities within India to get internet access and broadband access to individuals? You can hopefully bring them out of like poverty. All of a sudden you have kids in rural India who are coding. So I think it's just extremely, extremely powerful with what he's doing on that Starlink business. And what's nice too is that Starlink business brings in more free cash flow, which helps support the launch business on the other side. So that's what's attracted us to SpaceX, and I think he's hopefully one day can turn that into $1 trillion company.
I hope so. Yeah, that's fascinating, and it must have been difficult to participate in the deal.
It's extremely all these deals. It's extremely difficult to get access into those underlying deals and to participate. So, and that's the whole reason behind Stack is we'll do the legwork, we'll use our connections and our network to participate in these companies so that everybody can participate in them by buying our shares on the TSX.
Yeah, for sure. I like that. Yeah, super, super interesting. So those are three super unique ideas that I think have that huge outside return potential. What's the difference? So what's the expected returns from these kind of vehicles versus a typical publicly traded stock? I know there's and PE is probably not the valuation metric to use, but there's typically kind of a revaluation when it goes to the public markets. Is there a typical kind of revaluation that you can use or that you use?
It's hard for us to give like a typical revaluation of like what we're using here. Like what we really want to do is we want to compound more than 15% per year book value per share. So book value per share is going to be that best metric as to if we continue to compound that internally, recycle these names, we think we can do extremely well for shareholders over a period of time.
Yeah, no, that's fair. That's a good point.
But
so how do you...
You can see some of these underlying portfolio companies when they IPO what happens, and you really need to get in that last like 1 or 2 rounds where the company works, that you know that there's a proven product market fit, and you have the security of being in that pref stack, and so you can not only get the lift to the IPO price, but hopefully that lift on day one as well when it comes out of the gate.
Sure. So how do you participate? Is it equity only, or what's the type of ownership that you usually get?
It can be everything. What we're looking for is our prefs that are later series prefs, just because it gives us that more security being up on the pref stack. If, let's just say, worst case scenario, company did have to liquidate, and we're hopefully getting our money back first before somebody else. But we can participate in convertible notes, we can participate in preferreds, we can participate in common. You generally want to participate in the common when like you're very clear that this thing's going to IPO, because upon IPO, the entire stack of the pref stack, most likely to convert as well, is going to convert into equity, so everybody will be the same. But when you're in the private market, you really want to be ahead of everybody else just for safety for your underlying shareholders.
Yeah. So with these, some of these companies, would they have access to raising capital through the banks as well? Like the banks lend the money too, typically, or is it mostly just equity?
In terms of like the banks raising the money, in terms of like, a lot.
And the banks, providing liquidity to the companies.
Yeah, some of them are lenders to them, and then if you're a lender, then that deal is definitely going to come through you in case they do like a Series A or Series B or Series C. But there's so many different, like, a lot of these companies get prompted directly from like venture capital funds, and you almost have some like the top law firms in the U.S. acting as the banker. So the law firm will put all the documentation together versus bringing a banker into the room. But it varies. It's very niche. Like each individual deal is its own beast.
Yeah, I would think so. When I think about it's such a different market. I mean, you've put together 3 deals so far. What's your kind of view from where you are today to fully invested? Is that something you think about?
Yeah, I think when we went out on the IPO, we sat there and said within a year we think we can be fully invested. The one learning lesson that I take from starting this, in the private market, it always takes longer than you think in terms of getting the deals done. So when we were working on a few of them, we thought they were going to close in like 2-3 weeks. Ended up taking 6 weeks to close that deal. So we still think we're on pace for that year full deployment in terms of the underlying capital. There's a number of deals that we've been working with in the past that we're working in, like, hopefully we expect to close them in short order. So there's a lot of exciting stuff that we have working on in the back that we want to bring to market.
Okay, that's good. So what happens with the current structure right now? So the money that's not deployed sits in basically T-bills or something like that?
Yeah, we sit it just in basically money market funds, like capital that we can basically take out very, very quickly. We actually got a very good prime rate, so we're happy with that where it's sitting.
That's good. How would you track, like how would the average person track valuations on the deals that you have, but also, obviously you can look at the market and see bid ask, but how would you
Yep.
check like valuation, like book value, for example?
In terms of our underlying book value
Yeah.
okay, in terms of our underlying book value, you'll be able to see that quarterly with our financials, and there might be some periods of time where if something does get a big markup where we actually come to the market and say, okay, our book value adjusted by XYZ, here's an
Yep.
estimation. So the
Yep.
best is going to be the quarterly financials that you'll get from us in terms of those underlying positions. And
Yep.
we're very transparent. Anything that we buy, we like to press release out there in the market so the market knows the underlying positions of the companies that we have.
Yep.
But you can see that from the financials for us.
Yeah. So with private deals, how often would they remark their values? So like SpaceX, for example, you only get a new value when they raise capital, or like how does that work?
Yeah, in terms of SpaceX, like they actually just did a deal the other day around 100 billion that they raised capital at, which was quite impressive. We got in
Okay.
before that, which was quite nice.
Okay.
So you'll see what's happening in the private market is you're seeing more and more of these companies come to market faster and faster. So as
Okay.
opposed to waiting 2 or 3 years for another deal to have a mark on that underlying position,
Yep.
you're seeing that generally within like 6 months to a year, maybe a year and a half, just from like the speed of deal activity. So we get marks from those underlying positions there, and then we have business valuators look at some of our underlying positions and then go through with the accounting firms. PwC is our auditor, and go through to mark those underlying positions.
Okay. Yeah. Makes sense. Yeah, it's because I work and most people follow kind of publicly traded markets more
Yeah.
often, right? You see tick by tick, you see what everything's worth from that perspective, and that's not always a good thing.
It's not always a good thing. It's like you put the ticker over your house and watch your house go up and down, up and down, up and down every single day.
Yeah,
It's not.
that's a good point. Do you think that ever happens? Do you think we get to tokenization on real estate?
That's actually a good question. I mean, maybe one day. Who knows?
Yeah. So on the crypto side, have you seen anything on tokenization? Have you seen companies that do that? Do you follow like T0 and any of those businesses?
So I'm not the crypto expert. My CFO, he's the crypto expert.
Sure.
He was
Yeah.
CFO of Hut 8 Mining, $3 billion company on the TSX. But
Yeah.
and I sit here and ask him questions on this stuff all the time because I
Sure.
find it absolutely fascinating. Some of
Yeah.
the most profitable businesses we have seen have been U.S. exchanges. I won't name
Okay.
names, but like
Yeah.
some of the numbers out of them, like
Mhm.
you're talking billions of dollars of revenues
Yep.
with billions of dollars of earnings
Okay. Yep.
out of companies that are 3 years old. And
Wow.
it's just mind blowing the pace and adoption of some of these cryptocurrency trading organizations.
Yep.
The numbers have blown me away.
Yep. Yeah, it's fascinating. I mean, I think that's part of the interest for me too. It's I've been in business for about 20 years now, and I haven't seen really anything. I guess the internet kind of was, but I haven't seen anything happen at this pace. And so it is, you try to look at it with where's the opportunities, and I think a lot of them are still in the private space. So I think that it's still huge, unique opportunity. So. I would like to ask you a little bit about some of the names, like some of the SPACs in the U.S. that have kind of been beaten up. Like you look at like Lemonade and Sumo and Stone and like some of these companies that were high flyers last year when they first came out of the gate, and now they're down, I don't know, 75% from their highs. What do you think's going on in that space? And is it just the businesses came? Are they IPO too early, or what's kind of the issue you see potentially?
I think you get some of these venture capital funds that just prime these businesses and get ahead of themselves, and the founders taking on more capital at elevated valuations that they have a hard time growing into. And then what happens is you push that out into the market, and people are like, okay, let's annualize this number and then annualize that number. No one's actually looking at the real revenues of what does this company actually do. Everyone talks ARR, and it's like, okay, but the company has to grow into these underlying valuations. So I think a lot of them have come out too early, and what they're not used to as well are quarterly earnings. You have analysts and people who are looking at you every single quarter, and you slip up with 100 times revenue multiple, and your growth goes from 50 to, even if it's like 40 or 45, you're going to get annihilated in the public markets. You just get absolutely slaughtered. So, and I don't think a lot of them, like, I want to be a public company, I want to IPO, and I want to sit on the New York Stock Exchange and ring the bell that morning. Okay, but is your company really ready for prime time? And I think a lot of those companies weren't ready for prime time, and they came out way too quickly.
Got it.
I will also add on top of that too, you sit there and you see like the government, the U.S. 10-year, right? And what happens, interest rates and that duration risk that a lot of these guys are coming. You can't just keep on feeding these things and they burn money. Like at one point you're going to have to be a profitable company that goes out there on the exchange. And like we're even seeing some companies that are multi-billion-dollar businesses that are actually profitable in the private sphere. It's crazy. Like when you can find those ones that are growing at 50% plus that are already profitable, like those are the things that just really, really excite us.
Yeah, for sure. I mean, that's unique. That's different. So, do you think some of these businesses will die? Like, you think some of these techs that launched in the last 24 months will die?
That is the one risk with tech, right? You're constantly on that treadmill of innovation, and you might think your thing is sticky, and then all of a sudden somebody comes out of Y Combinator in the States, or some other young guy comes up with something new, and now you're displaced, you're disrupted. So I don't know how many. Like, you're definitely going to see deaths of companies that just can't make it in the public markets, or they become orphan stocks and nobody cares about them, and they just trade for $1 and it's a $200 million market cap company that no one's going to pay attention to. And then maybe they're swallowed up by another big conglomerate that sits there and says, hey, I have the multiple, I can take you on. So I do think you'll see more M&A. I think you'll see some deaths, but I think you'll see some absolute all-stars come out of the ashes of some of the sell-off. Yeah,
fair enough. So what's the vision for Stack Capital? What's the vision for, you want to scale the business? You want to continue to grow it? What's the vision?
Yeah, we want to create this into a very big organization where the more data rooms that we get access into and the more companies that we see, the smarter and smarter the system gets. And the smarter the bets that we can place on these underlying companies become. So we want to be one of those bigger organizations where everybody can participate in this, and we have a system where we can look about just about anything. And it's not just phone calls going out. There are now phone calls coming in from founders saying, hey, we really like what you're doing. This is actually really ESG friendly as well. Like, we would like you on our cap table. That's the point, and that's the goal and vision for Stack.
Yeah. Cool. Exciting. Definitely. So as you talk, sorry, go ahead.
No, it's exciting. There's a lot going on. I'm passionate about what we do.
I like that. So as you meet with these kind of private companies and their executives, you bring up a great point. Is there more discussion around ESG, and is there more discussion around kind of, I don't know, we'll say kind of social balance maybe? I'm not sure that's the right word, but kind of more like it's important how the team is doing too, not just the profitability of the business.
Yeah, I think there's a lot more talk about ESG in these companies, from diversity of board of directors, in terms of you can even talk about Bolt, for example. He switched his company from a 5-day work week to a 4-day work week to help his underlying staff, where we're gonna work very hard from Monday to Thursday, But like you need some family time. You need to have that time for extracurriculars for you to be you, and you guys can work remote like wherever you want to. So I definitely think there's more of an ESG push on underlying companies out there for sure. Now there's a lot of that whole ESG greenwashing as well. Like I remember looking at Nestle and Nestle saying it was top of the ESG charts. Well, every time I look at a Nestle plastic water bottle, come on, where's that going to go? In the ocean and into the Pacific dumping ground of plastic?
Yeah, exactly. I as you probably can look up on Bloomberg or Thomson, all these companies have these great ESG ratings, but a lot of them are energy companies. So I mean, it's a matter of who's putting money into marketing their ESG platform. So yeah, it's interesting. I mean, I think a lot about how that dynamic's going to change if kind of that social sphere and that kind of that top down grinding that corporate America has had is changing. And so I wonder if there'll be. It sounds like you're saying to me that there is opportunity for companies to continue to do that and make money while they're doing that.
Most definitely, you're seeing more and more of it in the market, and even people are bringing it up more and more. But it's just getting that balance of like true ESG versus this is just washed ESG here, guys.
Yeah. So what have you been looking at now that's really getting your interest and attention? Obviously, you can't tell me any companies, but is there something that you've been seeing that's really unique that would surprise people?
Yeah, there's I'll play off themes to keep it broad, but just going back to that whole like travel and leisure, like the travel and leisure business out there, it's been hurt over the last 2 years, but we think we've found a gem in that space where they've done extremely well through the pandemic. Like you're talking about growth versus no growth. So we think there's a very interesting opportunity in that space. Content creator tools, as more and more people leave the workspace and they become their own boss, they now need to market those underlying businesses that they're coming up with in those tools that help them do that. I think it's a fantastic, excellent space. Cybersecurity, another very, very interesting one in terms of like you open a crypto account, let's say you open an account on like Coinbase or something else. How do you verify that, okay, Ben just opened this account and this isn't Scott opening it up on his behalf? So different companies like that are very interesting. Even ran across one last week's conference. This company would inject, let's say you have cancer and you're going to go in tomorrow because you're going to get it operated on, the surgeon's going to cut it out. Before you go in, they inject you with this dye where that basically dye attaches to the cancer. So when the doctor cuts you open, he knows exactly what it's cutting out because it just illuminates the cancer, where you're cutting out all the cells versus, oh yeah, we forgot about that one, and all of a sudden, then 2 years later you go back in and like you got the same issue because they didn't get all the cancer. Different things like that, where you're just sitting and seeing all these companies, you're like, wow, that's incredible. Like, how did I just find this now?
Yeah, that is incredible. That is incredible. What are we doing investing in publicly traded stocks?
It probably makes you want to invest in everything at the times, right? You just like so many good opportunities here. You don't know which one. I mean, obviously you have your metrics, right, that you're going off of, but it must be hard. You get excited about all these companies.
That's the thing. Like you got 15 to 20 slots that you got to fill, and you got just hundreds of just excellent companies that you're looking at, and then you got to start weighing them off. Okay, well, when are we going to get liquidity? Do we trust this management team? What's the underlying product? How big's the TAM? You're going through all these different metrics, try and balance it off, and put those companies in the portfolio.
Yeah. So does the macro play any part into your allocations as well? Like, would you take that into account ever?
We always pay attention in terms of like the macro. Okay, what's the U.S. 10-year? Where are we on that? What's actually happening in the public markets in terms of, okay, is inflation going crazy? Are rates going to go up to 2.5 or 2, whatever the number is?
Sure.
And it makes us think, because what are we really doing here? We're taking duration risk. We're buying private companies that, yeah, they're high growth, but you all of a sudden start adjusting that 10-year, and that's going to affect the multiple of the underlying business there. So we definitely do have that in the back of our head. But at the end of the day, we are what I would call stock pickers, but company pickers in terms of we're going in the minutia of that company. And at the end of the day, if it grows and has those margin metrics, you can grow into any valuation. But we are very cognizant of, we're going to buy at the right valuation. We're not just going to buy anything because, okay, it's a great story. It still has to be right.
Yeah, and your timeline's different, and things will ebb and flow, and those probably impacts your multiples, as you say. Any want to mention any comments on what Cathie Woods been doing and the ARC funds? Have you followed them? Do you have any views on what she's trying to do there?
I have followed them. She's obviously looking to go for the most disruptive, innovative businesses out there that, sure, they might make some money like 5, 6, 7 years from now, but she's definitely taking duration risk on some of those underlying companies. I do commend her for what she's built. She's built a very, very good, interesting platform. But yeah, it's definitely a wild ride on some of those companies.
Yeah, it's interesting. Certainly, some of those businesses are quite interesting, and quite disruptive. And it obviously appears that some of them went to market too early as well. To your point,
most definitely. I do agree with her in terms of the deflationary forces of technology companies over time. I'm with her in that camp. There are definitely deflationary forces coming from the productivity that different software companies or different biotechs or whatever it may be are putting on society. So I'm with her on that. But to your point, some of those companies come out early, and now you're withstanding guys who want quarterly earnings, and they don't want fluctuation in those earnings. It has to be just sticky. So it's tough to stomach some of that.
Yeah, I mean, Facebook, when they went public, they had a tough time. Like Zuckerberg had a tough time his first probably 4, 5, 6 quarterlies, and Shopify, for those who remember, Shopify, same thing. Like they got crushed the first couple of quarters as they adjusted to having to deal with the public market. So no, that's a fair point.
And that's why you see a bunch of these guys stay in the private market for longer and longer and longer. Like, let's get to that base of revenues where we know we're not going to slip up on quarterly earnings. We're doing well. We might even have profitability. And plus in the private markets, because there's so much capital, they can get the financing in the private markets. And the liquidity, like one of the other pieces that is continually being solved is they need liquidity for the underlying employees. Guys have options contracts. They need to exercise those option contracts. They need to get liquidity. You're seeing a lot of people come in and try and buy those shares via old employees or wherever it may be. So you're solving two issues where the companies are like, okay, well, why do we want to go to the public markets right now? At one point they're going to, but you can stay private, and you're seeing it. You're going to stay private longer and longer and longer.
Yeah. Well, I guess that means to your point, they're probably more ready than other privates might have been in the past. So,
exactly.
Yeah. So what are the questions that I haven't asked you? Is there something that I haven't asked you that's really key and important that I'm missing?
No, you guys. I gotta say, you guys are thorough. You guys are hitting all the questions. So I can't think anything else. You were definitely very, very thorough on that.
Yeah. Okay. Appreciate it. Scott, is there anything that came up? I'm sure your mind is just like racing with ideas on where we go.
I want Jeff's job. I want a seat at the table, Jeff. I want to go comb through those books with you, and I want to have a look at all those exciting. I'll work for like sweat equity or whatever. I just want to be in on the table. That's all.
Anytime you want to swing by the office or come in the office, come on in. I gotta say, we're right downtown Toronto, and I'm pretty sure we're probably the only ones going into an office right now. I think there's less than 2% occupancy in our tower. It's crazy. Wow, yeah. You don't see anybody. It's an absolute ghost town in the downtown.
Yeah,
for sure.
I think we'll probably take you up on that one day.
Yeah, definitely.
Come by, swing by.
Awesome. Well, before we go, yeah, why don't we just, if people want to learn more about Stack, I was going through your investor presentation today. It's good. Is that a new presentation for you guys? I think it says it's new January 2022. Because that's you kind of,
definitely newish presentation. We're going to come up with another one, hopefully just right after we report, and we can talk about what's going on in the underlying book, and hopefully there's some more positions by that time. So
for sure. So people can find
that's an
that
updated
at
presentation.
stackcapitalgroup.com. All the information's there, management team, board of directors, all that stuff is there. So I definitely urge people to go there if they want to learn more, or you can call Ben or myself, and we'll give you the lowdown on the connections as we need to.
For sure.
Okay, I think that's it. That's been great. Ben, do you have anything else?
No, just the company, the ticker is STCK, is the company on the TSX if you're looking for it. And there are warrants that are outstanding as well that are publicly traded too. So, Jeff, that's been awesome. I really appreciate you answering all the questions, being patient with us, and telling us a bit more about the story. I'm intrigued. I'm interested to see what's coming next for Stack. It's sounds like some exciting things ahead.
We're excited to get the news out there, and thank you very much for having me on the on here, guys. Appreciate that,
Yep.
and want to come back soon.
Excellent.
Awesome.
Look forward to it.
Awesome.
Excellent.
Well,
Okay.
thanks very much, and thanks for everybody
Thanks,
tuning
Jeff.
in. And if you haven't subscribed, please do. And we'll see you next time.